Welcome, options traders, and happy Friday to everyone. And another good question for the group here to round out the week. What's the cost of legging into vertical spreads? When I'm talking about legging into vertical spreads, just for this video, I'm talking about a long vertical. So let's say that you own a call and at a later time you sell a call against it. Now, of course, similar arguments would apply for really any type of spread. But just to make the conversation a little easier, we're just going to look at legging into a long vertical spread. And the reason I like this question is that a lot of times people just get focused on debits or credits. And they'll say in this case, well, if you're legging into a long vertical spread, it's a credit. You're selling a call against your existing call, so there's no cost. It's just cash in. And that is unfortunately why so many people end up legging into spreads or rolling, hedging, morphing, and they end up with a position that doesn't behave anything like they thought that it would because they're just focused on the money. And we need to understand when we talk about the cost of doing something, it goes far beyond dollars and cents. So let's take a closer look. What's the cost of legging into vertical spreads? So as always, before we get started, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's do a quick review of a vertical spread. So a long vertical spread is what we're focusing on for this video. But again, all of the concepts that I'll be talking about apply really to any type of spread. So for a long vertical spread, you're going to buy a call and sell a higher strike call with the same expiration. So for example, maybe you start out by buying the May $100 call. And at some time in the future, you decide to leg into the vertical spread by selling a May, let's say a 105 call, higher strike. And when you do that, because you're selling that option, you're receiving cash. And once again, this is the thing where most traders stop. They go, well, I get this nice big credit. I still have a call option. Yeah, I've capped my upside, but I still have a call, but I just got this big pile of cash. And they don't realize that there are other trade-offs. So all strategies, not just a vertical spread, all strategies have trade-offs, or a better way to see them is a cost, even though it might not be a cost in terms of dollars and cents. So in the eyes of an economist, remember that a cost doesn't always mean money. So when we talk about the cost of entering into a position, breaking a spread apart, whatever, it is not always measured in money, and that is critically important. So the cost of it, not only potential money that you might be spending, but it's also what you're giving up. So for example, in the eyes of an economist, let's say that we're on some little island here and you can exchange one pineapple for 3 bananas. So we would say that the cost of a pineapple in terms of bananas, notice I'm not saying in terms of dollars, but in terms of bananas would be 3. See, I'm not saying it's $3, I'm saying it's 3 bananas. And then of course we can look at the other side and say the cost of 1 banana is mathematically 1/3 of a pineapple. It's just the reciprocal. But the point being is that we can look at the cost of something in terms of anything, not just money. It's what we have to give up. So let's start off with the long call. So remember, we always get a bend right here at our strike. So that's our long 100 call, our hockey stick graph. This is the expiration graph. Remember that this curve here only applies right on the expiration bell. That's the only time you're going to get the correct answers or the correct interpretation. Prior to expiration, we need to look at what's called the current curve. And let's say there's 30 days to expiration. It might look like this. So let's say that we bought this $100 call, and it doesn't even matter where the stock was or what you paid for it. So that's a sunk cost. Once you've bought the option, it's never going to change, or at least the price you paid for it. So it's a sunk cost. And as that stock price, let's say, rises, starts going in your favor, let's say it comes out this way, maybe to 110. And so now you think, hey, I've got a great idea. Let me sell or short the 105 call. And yes, I understand that I'm giving up all of my rights above 105, but hey, I get this nice big pile of cash. And maybe even this pile of cash might be more than enough than the amount that I paid for the original $100 call. And this is where traders make a really big mistake and they say, oh, it's house money. Well, that's not true. There's no such thing as house money. It's all your money. But the point that I'm making here is that when traders decide to, let's say, sell this 105 call, they do it with one reason in mind, and that is cash. They say, what's the quote on it? Oh, look at this. I can push this button. I can get this nice big credit to my account. And again, they think that they still own this call option here. Yeah, they're giving up the prices above 105, but they still own this call plus this cash. And that is absolutely not true. You have changed a lot of characteristics, and those are part of the costs. So notice here, I'm not just saying that it's a big credit and that that's the only thing that we're doing is getting this credit. There are other things that are being traded off. So take a look at this blue line right here, the current curve. What do you suppose it looks like once I sell the 105 call? Now, of course, it's going to depend on how many days there are to expiration and the volatility and number of things. But for this example, I'm going to go from the blue line, ready for this, to the red line. Look at that. I've absolutely crushed these deltas. We used to have a delta way up here, and look at that. Almost completely flat. So as the stock price continues to rise, don't expect much out of this spread. Now, I'm just focusing on deltas for this video, but we have to also consider what happened to gamma, what happened to theta. We have lots of things that have changed. The key point is that you don't want to enter into this strategy or leg into this spread just because you get a credit. You must understand that there are also things that you gave up. It's not just about this credit. So you can see that if the stock does continue higher, look at this red line starting to flatten out here. If you had stayed with the original position, look how much more profitable it would be. So I'm not saying that it's wrong to leg into vertical spreads. I've done it many times and will continue to do it. I'm just saying that you have to be aware of what the costs are or the trade-offs. So to make the point, rather than just looking at some graphs from a pricing model, let's go over to a trading platform and see if this is really the way that it works. All right, so now we're into a little different looking platform. I'm sure a lot of you are going, wait, what's going on here? I'm usually either in Thinkorswim or in E-Trade. I'm still trying to get into my Thinkorswim account. It's a long story, but I have since opened up a Tasty Trade account and have to say this is a really cool platform. For those who are not familiar with it, it is developed by Tom Sosnoff, who is also the person that created Thinkorswim. So there's some similar looks and feels to this platform. But the thing that I wanted to show you is this. I'm going to use NVIDIA. The stock closed almost at 135. So I'm looking at the options here with 36 days to expiration. And let's just say hypothetically that we buy the 135 strike and sell the 140. So I'm going to go over to the curve, and here we go. So one cool thing is I can grab these little flags right here. I can change the strikes right there on the fly and look at all kinds of what-if scenarios. So the thing that I want to draw your attention to is over here on this analysis tab. We have to activate it. So there's our vertical spread, and I can also break them apart right here, see what the effects are. So for right now, let's get rid of the short call right there. And you can see that I've got the delta graph right there in purple. So the stock, remember, is at 135. So let's find 135 right about there. And if you look right here, it tells us that the delta is 54.41. Let's just call it roughly 55. So what would happen if I leg into a spread? Now, once again, people say, oh, not a thing. I still own the call. I just get a bunch of cash. Well, let's see if that's true. Watch what happens if I include that. And now let's find 135 for our stock price. And there it is. And look at your deltas, 8.5. That's a big difference from 55. So again, you can see that, yes, even in a real platform, it's showing you that your deltas are going to get crushed. Now, once again, that doesn't make it bad. That's not my point. My point is that you need to understand how the entire position is changing. So another cool little feature here, I can click on calls or puts, and I can see the bid and offer at every single expiration and every single strike along here. And so those are some things that can also help you to make decisions. But the main point I wanted everybody to understand, because I hear this from lots of traders, is don't get caught into this routine of let me sell a call as soon as I can get some decent cash for it, and then that way I still own this call, but I've just got this big pile of cash. If you do that, you are probably going to end up with a position that is not going to perform anything like you thought it would. And that's when people scratch their heads and go, I don't know why it's not moving. I don't know what's going wrong. Let me just close it and move on to something else. Well, if you had known the way that it was going to work before you got into it, you're armed with better information and can therefore make better decisions. When you make better decisions, you're going to have better outcomes. So I hope that helps you to understand at least one of the key trade-offs whenever you leg into vertical spreads. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.